Please, can somebody confirm you can hear me clearly?
We can hear you, sir.
All right. We shall continue with the topic we started 3 weeks or 2 weeks ago. We are looking at sources of finance for those that have been following this class. Precisely 2 weeks ago, we started the second topic, sources of finance. Under this topic, we have looked at sources of equity financing. We have discussed equity financing sources. What is equity financing? This is the finance or the money contributed to the business by the owners of the business. We discuss equity financing. Under equity financing, we discuss retained earnings, issuing of new shares to raise additional fund. Under issuing of new shares, we have public offer, private placing, rights issue. Thereafter, we discuss sources of debt financing. Last week, we treated debt finance sources. What is debt finance? Debt finance refers to all forms of borrowing. A company can decide to borrow money to finance its operation. So we discussed debt financing last week. We look at long-term debt financing, medium-term debt financing, short-term debt financing. That was what we treated last week. Tonight, we shall be looking at equity, we shall be looking at Islamic finance sources. What is Islamic finance? What are the different products you can use to obtain finance under Islamic finance? Part of your syllabus said you must understand Islamic finance sources. In Nigeria today, we have Jaiz Bank, an Islamic finance bank. We have Lotus Bank, an Islamic finance bank. We have Taj. Islamic finance is growing in Nigeria. Islamic finance is available in UK. Now, what is Islamic finance? Islamic finance is a finance, a means of sourcing finance that is based on Islamic law, Islamic finance. This is a means of raising finance based on Islamic law. It's a financial system that is based on adherence to the principle of Islamic law. This Islamic law is referred to as Sharia law. It offers, Islamic finance offers services, financial products, financial instruments that are based on compliance with the principle of Islamic Sharia. Under Islamic finance, it is prohibited to collect or pay interest on lending or borrowing. Under Islamic finance, it is prohibited to collect interest or to pay interest on your lending or on your borrowing. Also, Islamic finance cannot be used for trade or activities that provide goods or services considered contrary to the principle of Islamic Sharia. Please let us note this. I'm going to repeat that point. Islamic finance cannot be used for trade or other activities that provide goods. Let me expand this more. Let me expand this. So please, this topic is beyond religion. The topic we are taking is far beyond one religion. You can decide to go to Islamic bank and obtain loan. They will not ask you whether you are a Muslim or you are a Christian. All right. We said Islamic finance cannot be used for trade or activities that provide goods or services considered contrary to the principles of Islamic Sharia law. For example, you cannot approach Islamic bank to obtain loan for the purpose of funding alcoholic business. Not only interest now. There are two aspects to Islamic finance. One is Islamic finance prohibits interest payment. Interest is regarded as riba under Islam. So Islamic finance prohibits interest. If you are collecting loan, you are not expected to pay interest. If you are lending also, you are not expected to collect interest on your money. The second point is Islamic finance cannot be used for trade or activities that produce goods or services considered contrary to the principles of Islamic law. A good example is alcoholic business. Alcohol business under the Islamic law, alcohol, whether consumption, manufacturing, in fact, you must not assist in any process of alcohol. You must not assist in any process of alcohol business. Even documenting alcohol business is prohibited under Islamic law. You must not be involved in any activities that involve alcohol. So you cannot approach an Islamic finance bank to obtain loan to finance alcohol business. Same applies to tobacco business. The same thing applies to gambling business. You cannot open a gambling shop. You now say you want to obtain loan to be running your gambling business. That is the principle of Islamic finance. Under Islamic finance or under Islam, money is not regarded as an asset from which it is ethically permissible to earn a direct return. Your cash is not an asset. You cannot say because you have gotten cash, you now give loan to somebody will now pay you interest. Money is not regarded as an asset on which you can give loan to earn return. Money is viewed under Islamic law. Money is considered purely as a medium of exchange. Interest charges can lead to injustice and exploitation in the society. Hence, interest in bracket riba. The meaning of interest in Islam is riba. Riba is completely prohibited on lending and borrowing. All right. This is the principle of Islamic finance. Our second discussion. We want to look at Islamic finance products. What are the different products in Islam that you can use to source money? If you are looking for finance for your business, what are the various products under the Islamic finance that can be used to obtain finance? Number one is musharaka. Please look at your screen. You can also check page 138. Number one is musharaka Islamic finance products. This product is a profit and loss sharing partnership. This product is a profit and loss sharing partnership, and it is the most authentic form of Islamic finance. Musharaka is the most authentic form of Islamic finance. Under these contracts, under the contract of Musharaka, two or more partners jointly provide capital to finance a project or own a real estate or a movable asset. Under this contract, two or more partners. Bank is regarded as a partner now. Two or more partners jointly provide capital to finance a project or own a real estate or a movable property, a movable asset, either on a permanent or diminishing basis. The partners participate actively in the management of the business. The partners, including bank and the customer will jointly contribute finance. We jointly contribute capital to finance a project. The bank and the partners will also take part in the management of the project. This is partnership banking now. Under these contracts, we call it profit and loss sharing partnership. This means that where profit is realized on the business, both the bank and other partners will share the profits in accordance to the pre-agreed ratios, where profit is realized on the project. Both the bank and other partners to the business will jointly share the profits in accordance to the pre-agreed ratio. Alternatively, if loss are incurred on the business, the loss will be shared between the partners and the bank in accordance or in the proportion of capital contribution. So both the bank and the partners will also bear the loss. So no payment of interest. If you compare this to conventional banking, the bank will give you loan. At the end of the month or at the end of the year, you are going to pay interest. The bank is less concerned whether you make profit on the business or not. The bank will continue to collect fixed interest on the loan. That is conventional banking. That is not allowable under Islamic finance. All right. The second product, Mudaraba Islamic finance products. Please be mindful of the spelling. Mudaraba Islamic finance products. This is a profit sharing and loss bearing contracts. I will take that again. This is a profit sharing and loss bearing contract, whereby one party provide the funding, one party will provide the finance needed. In brackets, the capital owner. The other party will provide efforts and management expertise with a view to generating profits. The bank will provide all the finance needed. The bank becomes the capital owner. Then the individual, the customer now. The customer will provide efforts and management expertise to manage the project or the business with a view to generating profit. At the end of the period, if a profit is realized on the business, where profit is realized on the business, both the capital owner and the manager of the enterprise will share the profits on the basis of pre-agreed ratios. Both the bank and the manager of the enterprise will share the profits in accordance with a pre-agreed sharing ratio. However, in the event of loss, only the capital owner, that is, only the provider of capital, in this case, the bank is the provider of capital, only the bank will bear all the loss. The customer will not bear any financial loss again. A bank has given a customer a loan of 100 million to run a project. That customer has a responsibility to provide energy, efforts, and management expertise to manage the business to success. If that business succeeds or succeeded, if a profit is generated, both the bank and the company will share the profits based on pre-agreed ratio. Alternatively, if a loss is incurred, only the bank will bear the loss. Remember, the bank has provided 100 million. The amount of the loan, the amount of the principal will be reduced by the amount of the loss. The principal amount will be reduced by the loss incurred. The company will not bear any loss because the management of the company has lost time, energy invested in the business. So you are not expected to incur financial loss. Every day you go to office, you are spending your time in the office, you are managing the business, you have exercised due diligence in running the business. But you must realize that business can go either way. There are times we make profits. There are times we incur losses. Nobody makes profits every day or every year. There are times your profit will be so high. At times you have just a marginal profit. In some instances, you incur losses. But you have invested your energy in the business. You have invested your time in the business. You have invested your expertise in the business. And you have lost this. Your knowledge is also worth. You have lost some worth. Your time is your worth. That is the concept of Mudaraba Islamic finance products. Number 3, Murabaha. Please carefully watch the spelling. Yes, for some of us, or for most of us, even the Muslims, some are not familiar with this. Even some Muslims say, talk less of non-Muslim.
I can't hear you. Was it just me?
I think we lost his call.
Sorry for the interruption, because some students might be having challenges. So let's continue with the class. That person is trying to reach me from Warri Delta State. You can look at the power of IT. Anywhere you can click to this and get your lecture. All right.
Like me from Delta now.
Ah, Mr. Ahmed. Thank God for blessing us with knowledge. Some people work towards this. Knowledge endows us with knowledge. God endows us with knowledge.
These are the benefits of outcome of COVID.
All right, thank you, sir. And let's continue. Number 3, Murabaha Islamic finance products. This is a popular Sharia compliant sale transaction, mostly used in trade and asset financing. I'll take that again. Murabaha is a popular Sharia compliant said transaction mostly used in trade and asset financing. How does this work? The Islamic bank will purchase raw materials on behalf of the customer and deliver this to the customer, deferring payments to a date agreed by the two parties. For example, assuming Mr. Ahmed Jamil has a bakery business in Delta State. You are the owner of this bakery business and you require raw material on a daily basis to bake your bread, bake your cake, and bake your other products. Flour is your major raw material. You can approach Islamic Bank to enter into Murabaha contracts. Under this contract, bank will buy all the raw materials you require for production. You have gotten a factory. We can see the factory. You have your machine to bake your bread. We can see it. You have your employees. We can see it. But you require raw materials on a daily basis to bake your bread and make sales. You can approach Islamic finance to enter into Murabaha contracts. Under these contracts, bank will purchase all the raw materials you require for your bakery. You are an expert in baking. Bank will deliver these raw materials to you, deferring payments to a date agreed between the two parties. Bank will have paid for the raw materials, but deliver it to you. Now the expectation is you are going to bake your bread every day. You are going to make sales every day. Then you are going to generate money every day. You now be making repayments for this raw material based on the date you have agreed with the bank. In addition to the repayments of the money, bank will charge an expected return on this transaction. This expected return, bank will work on the percentage. The percentage of your profits that you are going to pay is closely similar to like interest, but they don't call it interest. In the sense that this percentage is based on the profits, not on the loan they have given you. Assuming they have bought raw material that was 50 million on your behalf, you are going to pay that 50 million back based on the date you have agreed with your bank. Then certain percentage of your profits will now be paid as return. Your profit will fluctuate every time. That means it is not an interest. It is not based on the principal. It is based on the profits you have made. And if you don't make any profits, that means they cannot come and They cannot come and calculate and take your loss again now. They cannot tell you to come and pay return on loss, because the concept of Islamic finance, interest is prohibited. That is murabaha. Then number 4, ijaro. Some people call it ijara. In Islam is ijaro. That's A is taken as raw. Ijaro. Ijaro is listen. It's like listen. It's actually listen. What is ijaro? It's a contract of sale of the rights to use an asset for a period. Let's check the comments. Okay, I'll answer that. Ahmed Aigbe, can we hear you, please?
Yes, sir. Good evening, sir.
Yeah, good evening.
Okay. The murabba that you just explained, right? So I actually totally agree with the concept of the whole murabba, the inventory, which is asked to do with financing a particular purchase for a company. But the aspect of the fact that you said their interest is based on the profit that you made, that's where I have some little concern, because currently my company, we have a murabba facility with Jaiz Bank, and whether interest or no interest, they collect their, I don't know how they ascertain that, because they have a fixed interest rate that is applicable to that facility. So, and at the end of the tenure, they deduct accordingly. They actually charge their interest accordingly. So that is the part that I'm having concern.
That's
The
your
interest,
concern.
yes, that's the interest part. So is it
Okay.
really applicable in a real setting? Because I don't think they actually apply that concept of whether you make interest or not, profit or not.
All right. Okay. Thank you for that comment. Under the principle of Islamic Sharia, the issue of interest payments or collection is completely prohibited. Now, what we have in Nigeria is not 100% Islamic financing. There's a bit of dilution of conventional banking, and you can't blame them 100%. If you look at a pure Islamic environment, you have what we call an optimal and what we call like 100% honesty. If you look at a pure Islamic environment, both the bank and the customer, they work towards 100% honesty. That means if I run the business and you have supported my business under Murabba and I've made a profit of, say, at the end of the period could be monthly, and you are taking 1%, I should be able to speak the truth and say 1%, because there could be instances where I'm going to incur loss. So if I make profit in the month 1, you take 1%. and month 2, maybe I sustain loss, then I know that bank will not disturb me. But Nigerian environment, you understand the fact that our honesty is shaking. The banks are being careful that if we open Islamic finance fully to Nigeria, in concept, Nigerians, even the Muslims, the issue of speaking the truth, somebody will now continue to tell you, knowing fully well that if I report Lot 6, they will not collect anything. Somebody can continue to tell you that we didn't even make profits. And it becomes difficult to say, let's get them. So what they do is that they charge something like conventional interest. They will give you Muraba contracts. They will now put a fixed interest on the principal. If you look at it, that will negate the principle of Sharia. That's why we said the expected return on Muraba is usually aligned. Look at this, please. The expected return on Muraba is usually aligned with interest payments on conventional loan. What they do is because of the environment we find ourselves. Ordinarily, the issue of interest should not appear in Islamic finance. That is one aspect. The other aspect somebody asked me is, do we have to wait until the end of the financial year? The answer is no. You know, there is a date for repayment. The raw material you are using is your working capital. That means you are likely to require this raw material every day or every week, depending on your turnover and volume of sales. So the payment pattern will have been agreed between the customer and the bank. So you don't need to wait until end of the financial year. In fact, company will have prepared profits, maybe quarterly or monthly. In fact, they will do monthly. My former company, we are going to do monthly profits. Although we are not going to report our financial year, that is management account now. We are going to do monthly profits, management account. But the financial account will show our yearly profits. I hope it's better. Ahmed and the other guy. Yes. All right, let's continue. So on your Murabaha, the return charge is similar to what happened on interest payment because of the environment we are finding ourselves. All right, we are looking at Ijaro. Ijaro is a contract of sale of the rights to use an asset for a period of time. In other words, Ijaro is essentially a lease contract. Leasing, whereby the lessor must own the lease asset. The lessor must own the lease asset for the entire lease period. The ownership remains with the lessor. Because ownership stays with the lessor, the asset can be repossessed in the case of non-payments by the lessee because the ownership of the asset remains with the lessor. The assets can be repossessed in the case of non-payment of lease by the lessee, sorry. In other words, ijaro is a lease contract whereby one party provides the assets, the owner of the assets. The other party pays annual lease rental to be able to use the assets for a period of time, usually a short period. So you can enter into ijaro, more like operating leasing. You are going to the bank, Islamic bank can go into ijaro with a customer. Like the example we gave now. You run a bakery business. You require a machine to bake your bread and other products. This machine will cost like 100 million. You don't have the capital to buy the machine outrightly, but you have gotten the expertise in baking. You can approach Islamic Bank to enter into ijaro financing. The bank will buy the machine. The bank will now lease the machine to you. You will now pay lease rental, maybe monthly or annually, for the number of period you want to use the machine. The machine will be delivered to your factory, but the machine belongs to the bank. At any point in time, the lessee fails to pay the annual lease rental. The bank has a right to repossess the assets. The lessor is responsible for the maintenance of the assets. Unless damage to the leased assets results from lessee negligence. This is ijaro. Then the last one is Sukuk. We have Sukuk bond. Sukuk is the Islamic equivalent of bond. Sukuk is the Islamic equivalent of bond. They are similar to asset-backed securities. That is, if you're talking of Sukuk and all Islamic products anyway, there must be an asset. We are going to use that money to finance. Why conventional bond? If you look at conventional bond, commercial bond, normal commercial bond, is a promise to repay a loan. Under Sukuk, Sukuk constitutes partial ownership in receivables. Let me explain that with illustration. Remember bond, debt finance. A company issue bond to borrow money. Based on the agreed terms, the borrower will repay with interest. Under Sukuk, government can issue Sukuk bond to finance a specific asset, maybe hospital construction or hostels construction. We can look at Unilag, that our students are faced with accommodation problem. For most universities, particularly government-owned university, accommodation has been a major concern. Unilag can issue Sukuk bond with an intent to construct a big hostel for the students. They will now invite subscription from the public. Unilag, assuming Unilag has issued Sukuk bond, we now expect the investor to subscribe. The investors that subscribed, that is individuals, we have partial ownership in that hostel. Assuming the hostel will cost, like, say, 1 billion naira, they will now make it public. Please, we want to build hostel with Sukuk bond for Unilag students. We are going to subscribe. When the money is generated, it will be used to construct the hostel. That means there's an asset now. That asset is the hostel. The investors, people that has invested in that bond, they are the owner of that hostel. That is partial ownership. If I have subscribed for 10%, that means I have 10% ownership in that hostel constructed. Maybe you subscribe for 5%. We have different percentage. That is partial ownership in receivables. If the hostel is completed now, we expect students to come and use. Please, I'm going to respond to your question or comments. We expect students to come in every year, and students will pay for this accommodation. I know of a lot of students that is paying up to 500,000 to get a place near the school. That means we can provide this. Now, students will now rent this accommodation. That means the school will generate money from it. Although the intent is not to generate money, the intent is to address the problem of the students. Because those students are actually our children. The more they are comfortable to study, the better for them and our future. So the intent of that Sukuk is not because we want to make profit from that investment. We want to address that societal problem. We can spread the cost. If I subscribe for 10%, that or 5%, I can afford it. Now, if profit is coming from it, money realized from it, some part will be kept for maintenance. Some will be distributed to the investors. That's why we call it partial ownership in receivables. Let me look at the comments. So many comments here. Okay, it's not for me. Yes, Mr. Ahmed.
Okay, sir. Thank you very much, sir, for your explanation so far. I just want to be clear about something on this Sukuk. The example you just gave concerning the construction of hostel in an higher institution and so on. Yeah, I really believe that, just like what you said, the intention is not to make profit, which is what the Islamic financial system is all about. But no matter how, there is a kind of small income coming in from there for the people that subscribe to that bond, Sukuk bond. But the one I'm looking at, if you look at Lekki Expressway in Lagos State, Isagamu, Benin, or a road along this axis where I am, are being financed by Sukuk bond through the federal government. And I realized that there is no any income. It's a kind of zero income coming to the federal government in that regard. So what is the difference between that one and the one of financing and also that you just gave?
All right. Like you rightly said, at the point of issuing the Sukuk, government will have explained to the investors through the, what's it called now? Of course, the advert or the form will have explained that your investment in this is to assist government to achieve road construction. However, when you assist us, we are going to pay you, of course, we are going to pay you certain amounts, maybe yearly, for some period. That means the investor at the point of entry. The government might not be earning direct return from that road. Government might not be taking toll plaza on that road. But remember that road, people that apply it, part of the licensing you pay, certain amount is removed for that road maintenance. If you look at it, by the time you want to renew your car, a lot of things we pay. Your license, different things they're asking us to pay. Indirectly, all of us that we are using road, we are contributing. Certain amount will be deducted, like the last time. Licensing now, how much? Maybe like 40,000 now. At a point, they have increased the insurance again. Different charges. As if car owners is the one government is looking for. What they do is that from those charges, certain percentage is taken to maintain that road funded by Sukuk. Certain percentage is also given to the investor. Government is aware that if we tow this road now, they will not say, government is giving us road, it's still charging us. That's why different things will come from car owners, except you don't have a car. And nobody pray to be, not to have luxury in life. No human being will not want something that, in fact, car is not even luxury. Car is a necessity, at least one car, one functional car. So, and when you have this car, different charges. So that is how it's going to work. Is that clear, Mr. Ahmed?
Yes, sir. Thank you very much, sir. Thank you.
All right. That is that about. Is anybody speaking? All right. Before we take today's question proper, assuming you are asked, to compare conventional financing with Islamic finance, assuming you are asked, compare conventional financing with Islamic finance. What are the major differences? You can ponder over it and try to develop something around this, because this is your exam. At least one question will be texted under sources of finance. At least, all things being equal. You can ponder over it. Then also look at this question. In Islamic finance, explain the concept of riba, in brackets, interest, and how returns are made in Islamic financial instruments. Who can explain? Who can explain this for us? Yes?
Okay, sir. Just like what you said earlier, based on my level of understanding of Islamic law, when we are talking of riba, which is interest, is totally forbidden in the concept of Islamic banking system. And when we are talking of conventional source of conventional banking, let me put it that way, is interest is seen as a source of income to the investors.
To the bank.
Yeah, to the bank or to the investors in that particular financial institution.
Okay.
So it's and just like what I said, is whereas in the Islamic banking concept is totally forbidden. Though the way it's being practiced in Nigeria, just like what we said earlier, what is obtainable in a bank like a Jaiz Bank and so on is not 100% Islamic practice of financial institution, because they still try to bring a kind of a westernized culture of interest into it. But the little understanding I have with the interest.
All right, you tried. Now, who can take it from there? Why is it that
interest system is forbidden in the...
Okay, thank you, sir. Now, who can take it from there? Why is interest forbidden.
interest system is that it's
If
forbidden
interest
in
is
Islamic
forbidden,
concept.
if interest is forbidden, how do Islamic banks make profits? That is, explain how returns are made on Islamic financial instruments. You know, if you are explaining to a non-Muslim, and say interest is forbidden in Islam, then he will ask you, how do Islamic banks generate profit? Maybe they are in business now. So who can explain how return made in Islamic financial products? If you look at it, we said interest is the predetermined amount received by a provider of finance over and above the principal amount of finance provided. It is absolutely forbidden in Islam, in Islamic finance. Riba can be seen, that is, interest can be seen as unfair from the perspective of the borrower, the lender, an error. Please, just 1 minute. I'll come back now. Please just 1 minute. I want to add something here. Please, just 1 minute. I want to see if I can do this so that I can fully explain this. I was trying to get it out before the class, but unfortunately, okay, I'm almost there. Take me there. I want to copy this. Yeah, let me see if I can take it. Okay. I'll resume now. Seeing it. Okay. Okay, you can see it now. Where is this one coming from? Okay. Let's look at my screen. Oh, I've gone too far. Okay. I just want to quickly explain something here. Yeah, let's continue now. I'll come back to this. Look at this. We said, I hope you can see my screen.
Yes, sir.
Let me reduce this. Let me expand this. Yeah. Okay. All right. I want to explain this here. Interest, in bracket, riba, is the predetermined amount received by a provider of finance over and above the principal amount of finance provided. Riba is completely forbidden in Islamic finance. Riba can be seen as unfair from the perspective of the borrower, the lender, and the economy. For the borrower, riba can turn a profit into a loss when profitability is low. For the lender, riba can provide an inadequate return when unanticipated inflation arises. In the economy, riba can lead to allocational inefficiency, directing economic resources to Grace, stop touching my screen. Directing economic resources to suboptimal investment. We have explained interest. Now, how do Islamic banks generate return? Islamic financial instruments require that an active role being played by the provider of fund. That it is not sufficient to give me money, to loan me money. You need to be involved actively in the business so that the risk and reward of ownership are shared. That is what are shared. In Mudaraba contract, for example, profits are shared between the partners in the proportion agreed in the contract, while losses are borne or paid by the provider of finance. Look at this. Under Mudaraba contract, where profit is generated, the partners will share, bank will make profits. But where loss is incurred, only the provider of finance will suffer the loss. In Musharaka contract, profit are shared between the partners in the proportion agreed in the contract, while losses are shared between the partners according to their capital contribution. Next, with Sukuk, certificates are issued which are linked to an underlying tangible asset. Look at it. When you finance with Sukuk, you are given a certificate that will link you to a specific tangible asset, and which also transfer the risk and reward of ownership. The underlying asset is managed on behalf of the Sukuk holder. Next, look at this. In a Muraba'a contract, payment by the buyer is made on a defer or instrumental basis. Returns are made by the supplier as a markup. Returns are made by the supplier as a markup and is paid. The supplier now is the bank. The bank will buy the raw material, supply, Returns are made by the supplier as a markup and is paid by the buyer in exchange for the right to pay after the delivery day. In a JARO contract, which is equivalent to a lease agreement, returns are made throughout the payment of fixed or variable lease rental payments. So please, if you are asked to explain how returns are generated under Islamic products, you are going to technically or intelligently explain musharaka, mudabara, murabaha, ijaro, and sukuk. If you are asked to explain, and it's a good question, that, okay, explain interest, riba in Islamic concept. We say interest is prohibited because it's unfair. Now, explain to us, how do Islamic banks generate their return? So you are going to explain all the 5 products in a way that we can get return. All right? That is that about that question. Now, please refer to page 140, question number 2. Of course, for Islamic finance, they cannot ask you calculation question. It is always theoretical question. Most calculation question will come from conventional financing. So please refer to page 140, question number 2. That question on PSG. The question on PSG. Can somebody confirm that we are there now?
Yes, sir.
So I'm done.
All right. Let's go to this question together quickly. The following financial position statement as at 30th November 2020 refer to PSG and Co., a stock exchange listed company that wishes to raise 200 million naira in cash to acquire a competitor. Look at that. PSG is planning to raise 200 million naira in cash, so as to acquire a competitor. We have the financial statements of PSG. We have the assets, the non-current assets, the current assets, total assets. We have the equity and liability, share capital, retained earnings. Then we have the non-current liabilities. Look at it. Long-term borrowing, 100 million. We have the current liability. Under it, you have the trade payables. Look at short-term borrowing, 160 million. Next, the recent performance of PSG in profitability terms is as follows. Year ending 30th November, you are giving 4-year financial information. 2017, 2018, 2019, 2020. You have the revenue. Please look at the revenue. Look at the trend. You have the operating profit. That is the profit before interest and tax. You have the finance charge. That is the interest expense. You have the profit before tax. You have the profit after tax. This information was given to you. Additional notes. 1. The long-term borrowings are 6% bond, repayable in 2022. Remember, we are in 2020. This question says, this question assumes that we are in 2020 because you are giving the financial information up to 2020. So 2020 is the current year. We have the short-term borrowing consists of overdraft at an annual interest of 8%. Next, we have the current assets. The current assets do not include any cash deposits. PSG has not paid any dividends in the last 4 years. The number of ordinary shares issued has not changed in recent years. The target company, let me explain that. The company we are planning to acquire, our competitor. The target company is the company you are planning to acquire. PSG is planning to acquire a competitor. That competitor will be called target company. The target company has no debt finance, and its forecast profits before interest and tax for 2021 is 28 million. Requirement A for 15 marks. Evaluate the suitable methods of raising the 200 million naira required by PSG. Supporting your evaluation with analysis and critical discussion. These are likely questions that could be in your compulsory question. Look at this. This question is an implied question. A company wants to raise 200 million naira. You are the finance manager. Now, evaluate the suitable method of raising 200 million. What are the different methods we can use? We can use equity financing. We can use debt financing, or we can use Islamic finance. But you cannot just start to write. You need to evaluate. which one will be suitable for me? Which of this method will be suitable for PSG? It's an open question now. You must have a foundation on which you are going to base your discussion. I cannot just be writing about equity finance. Why should PSG use equity finance? Are you sure PSG can use equity finance? That means we need to look at the company performance. We need to carry out financial evaluation first. The company's performance will come from your profit statements and balance sheet statements. All right, let us go to the evaluation. Let us go to the evaluation. What you are expected to do. Look at the comments. The recent financial performance of PSG will be taken into account by the potential provider of fund. What we are saying is, before bank will give you loan, or before a money lender will give you money lender will evaluate your performance. You cannot just give loan without evaluating the performance of the borrower. Even if you want to do equity financing, the shareholders will look at your financial performance before they buy your shares. If you issue shares now, you can issue shares. But before the shareholders will buy your shares, the shareholders will evaluate your performance. That means we need to evaluate the performance of this company. Go to the question. Please give me the revenue figure.
Twenty 122.6 million.
122.6 M.
127.3 for 2018.
127.3 million.
156.6.
156.6.
And 189.3.
189.3. Thank you, ma'am. Next, please give me the operating profits. Oh, naira, sorry, not dollar.
41.7.
41.7 million. Next.
43.3.
43.3. Please, they are all in millions.
Yes. 50.1.
50.1.
56.7.
56.7. All right, thank you. Next. Give me the finance charge.
6.0.
6 million.
6.2.
Next.
12.1. 12.5. 18.8.
18.8. Thank you. Now, what are the ratios I can compute? I want to evaluate the performance of PSG. I can calculate operating margin, operating profit margin. This is, let me put the formula here, profit before interest and tax divided by the revenue. That is called operating profit margin. Multiply by 100. That's operating profit margin. Please compose. For 2017, operating profit is 41.7 divided by 122.6.
That's
Let's
34.
make it faster. You can go to year
34. 34.
34%. Year 2017, 43.3 divided by
34
127.6.
again.
34 again.
Yes, sir.
Go to 2019. Somebody can take 2020. Let's make it faster.
32.
32.
32%. Approximately 30. No, 3%. 30%.
30%. What can you see here? The operating profit margin tends to be falling. It was constant. Look at this. Between 2018 and 2019, there was a drop of 2%. Is that not?
Yes, sir.
Between 2019 and 2020, the percentage also dropped.
By 2%.
Good. Now, let us get revenue growth. What is the growth in revenue? Compare 2017 revenue and 2018 revenue. This is how to calculate this. Let's show it somewhere here. Let's show it somewhere here. Let's show some samples. Let me show some samples. Let me create this. Let's show some samples. Revenue growth. If I want to work that, I'll do like this. Working. 1. Revenue growth in percentage. You are going to say 2017 and 2018. Revenue in 2018, 127 point what? 0.3. Is that not?
Yes, sir.
Revenue in 2017, 122.6 divided by the base 2017, 122.6 multiplied by 100. That will give you the revenue growth between 2017 and 2018. Work that out. What do we have? Yeah.
7.3.
20.
7.3.
I got 4%.
3.8.
Yes,
Thank you. The
3.8.
correct answer is 3.8.
How did I get it? Before do it one.
You are going to put like this. 2017, you are going to put dash. The growth in revenue between 2017 and 2018, 3.8. Please, who is, can you mute? Now check 2018 and 2019. What is the growth? 156.6 minus 127.3 divided by 127.3.
Minus 127.3
23%.
Thank you.
divided by
That's correct. 23%.
156.
Now go to 2019 and 2020.
That
Revenue growth 189.3 minus 156.6 divided by 156.6.
I think they go put up. Because what I get now, 188.3.
No, that means you are making error. You have 189.3 minus
20.9.
Thank you, approximately 21. You need to correct the error now. Look at it, please. You have 189 point what? 0.3 minus 156.6 divided by 156.6 multiplied by 100. It should give you 20.9%. You look at the trend, revenue growth.
Sorry, sir.
That means
Sorry, sir. It's 20.88, which is approximately 20.9, but you wrote 21%.
if
I don't know.
That is even minor. Do you understand?
Okay.
That one is even minor. We can change that. Do you understand? That one is even minor. It's the least of the problems. I can round up to the nearest whole number. That will give me 20, 21. Do you understand? You can decide to round up to the nearest whole number. I mean, I don't want points. Come to the operating profit growth. Compare 2017 and 2018. That is 43.3 minus 41.7 divided by 41.7. What is the growth in operating profits?
I have 0.038.
Multiply by 100. Take it to percentage.
It's 3.83. That's
3.8.
Yeah.
Good. Now go to 2018 and 2019. Compare 50.1 minus 43.3 divided by 43.3 multiplied by 100. What is the growth in your operating profit yearly?
15.7.
15.7. Now go to the last one. Compare 2019 and 2020. 56.7 minus 50.1 divided by 50.1.
13.2.
All right, thank you. I have 3.8%, 15.7, Abi?
Yes, sir.
13.2. If you compare this growth, revenue is growing. Look at this. Between 2017 and 2018, the revenue grew by 3.4%. Between 2018 and 2019, revenue grew by 23%. Between 2019 and 2020, revenue grew by 21% approximately. Now look at operating profits. You observe that operating profit is growing more than, revenue is growing more than operating profits. Is that not? Hello?
Yes, sir.
Yes, sir.
What that means is that revenue is growing, but profit is not growing at the same rate as revenue. That means this company cost is high. It means that the company has higher operational cost that has reduced the revenue's growth. When you are done, let us look at the growth, financial charge growth. What is the growth in our interest rates? Please compare 20, where's the interest? Oh, the interest is here, sir. Look at the interest. Compare 2017 and 2018. Determine the growth rate in interest charge. Yes, let's make it snappy. 6.2 minus 6.0.
3.2.
Which one are we taking now?
I got 3.3.
3.3.
3%.
Compare 2018 and 2019. 12.5 minus 6.2 divided by 6.2 multiplied by 100.
101.6.
101.6%. Then compare 2019 and 2020. What is the growth in interest charge?
I got 50.4.
50.4. Now, look at this trend. Look at this growth in interest charge. Will you advise the company to borrow money? To borrow 200 million? Hello, guys.
No, sir.
Thank you. Assuming you are a bank, you now observe that this company interest expense is growing. Will you give this bank loan again of 200 million? Will you be willing?
No.
Bank will not be willing to give this loan. Now, this company interest is rising. Oh. Bank will not be willing to give the loan. Again, let's do like two things again. Let us calculate geometric average growth rates. Let me explain this. You can calculate for revenue for any items you want. You can calculate geometric average growth rate for any item you are interested in. I can say geometric average growth rate in revenue. Look at how to do it. Just come here. Pick this percentage. Percentage growth in revenue. 3.8%, 23%, 21%. Find the average. Look at it. Is equal to 3.8% plus 23% plus 21%. Everything divided by 3, because that is 3 figure. That will give you geometric average growth rates in revenue. Compute, I will explain later. You can also calculate geometric.
15.9.
Thank you, ma'am. 15.9. I will explain later now. Geometric average growth rates in operating profits. Let me expand this more. Have less than 30 minutes. And I want to try and round up the question within that period. But it will be wrong to start writing anything without small calculation. Let me still expand one more. I can do like this now. And come here. I'll pick the trend for operating profit, 3.8, 15.7, 13.2. Sum the 3 together. 3.8%, 15.7% plus 13.2%. Everything divided by 3. What's the answer here?
10.9.
10.9. You can see it. If you want to explain this, on average, PSG revenue is growing at an annual rate of 15.9%. Average. PSG revenue is growing at an average rate of at an annual rate of 15.9%. Why the profit, operating profit, is growing at an average rate of 10.9. That means 5%, if you look at it, between revenue and profit, there's a difference of 5%. Is that not?
Yes,
yes.
sir.
That 5%, it means that the operational cost of the company is high. The operational expenses has reduced the revenue. Operational cost is growing at additional 5%. All right. You can also compute, we are trying to look at it. If I want to give bank, if bank want to give loan, bank will look at your interest cover ratio. Is that not, please? we can compute interest cover ratio. I can come here, interest coverage ratio. You have 2017, 2018, 2019, 2020. Remember the formula for interest cover ratio. Profit before interest and tax divided by the interest expense. Go to your question. Pick your profit before interest and tax. That is your operating profit. 41.7, 43.3, 50.1, and 56.7. I have 41.7, 43.3, 50.1, 56.7. Then pick your interest expense. 6.0, 6.2, 12.5, 18.5. Abi? $18.8, sorry. Can we compute quickly? Divide the operating profit by the interest for each year.
7%.
7 was?
7%. 7 approximately.
Approximately, yeah.
The first point, let me correct one thing. You don't calculate in percent interest cover. You calculate in times. The number of times operating profit covers interest expense. So don't multiply by anything. Then you can give me to 2 decimal places. You should have 6.98 or 6.95.
6.95 for 2017.
Look at it. This will give me 6.95. That is the interest cover.
6.98 for
in times 6.98. Next.
$4.01.
4.0. 4.01.
4.01. Next.
3.02.
3.02. Now let me explain this. The interest cover ratio. This is the number of times a company operating profit covers interest payments. The higher the ratio, the better for the company. If you have higher ratio, it means the company has sufficient profits to cover interest payments. But if the ratio is low, that means the company is not making enough profits to cover interest payments. And if you don't have enough profit to pay your interest, that means your financial risk is high. If you don't pay the interest to the lenders can take the company to court and liquidate your company. That means if you look at what we have computed, in 2017, we have 6.95 times. 2018, 6.98, a marginal increase. 2019, it has dropped. 2020, this is falling again. This confirms that, or this is an indication that PSG financial risk is very high. The company is not making enough profit to cover its interest liability. In that wise, it is not sensible to raise 200 million again by borrowing money. Lenders will not even be willing to give them loan. With these financials, the lenders will not be willing to loan PSG. Okay? Let's do one more thing. Remember our discussion when we were taking lecture on capital structure to measure financial risk. You can use interest cover ratio. You can use financial gearing. You can use debt ratio. Let us compose the financial gearing of this company. Financial gearing ratio. Let me explain this briefly. For those that are just joining the class, financial gearing, this shows the extent to which a company has borrowed money to finance its operation. Your financial gearing shows the extent to which you finance your business with borrowed fund. If you borrow money too much, you are putting your business life at risk. Even as an individual, we must avoid borrowing. May God help us. Now, to calculate financial gearing, you can use prior charge capital divided by equity fund. Or you can use financial gain, you can calculate as total debt divided by equity fund. For the first one, let me expand this more. These are questions that examiner can test for 20 marks. Or you can drop it in your compulsory question for you. If I don't do this, it won't take up space. For your prior charge capital, prior charge capital, that is equal to long-term debt long-term debt plus preference share capital. That is prior charge. For this question, if you go to this question now, look at this question. Go to the balance sheet you are given. Non-current liability, long-term borrowing. This is long-term debt, 100 million. For this question, there's no preference shares. No preference shares capital. That means preference share capital is 0. It means that the prior charge capital will be 100 million. Because we don't have preference share capital in this question. Your equity funds, that is the shareholders fund, ordinary share capital plus reserves, that is equity fund. Go to your balance sheet, that is the statement of financial position. Look at it, please. Examiner says share capital, equity and liability, share capital, 100 million. Retained earnings, 121. Total equity fund, look at it, share capital plus retained earnings. Your retained earnings is your reserves. Equity fund is 221. Pick the figure. This is 221. If I want to use the first formula, that means my financial gearing is equal to 100 million divided by 221 million multiplied by 100. Work that out.
45.2%.
45.2, 45.2%. That means based on long-term debt, 45% of shareholders' fund is in form of borrowed money. If you look at the second formula, because we said financial gearing is the extent to which a company has borrowed money. That means for the second formula, we want to look at the total debt, both long-term debt and short-term debt. The first calculation, we only use the long-term debt. The second formula is total debt of PSG before the new funds. That is, I'll come here. The second formula is total debt. Total debt will be prior charge capital plus short short-term borrowing. We have gotten prior charge to be 100 million because there is no preference shares. Now go and check your statement of financial position. What is short-term borrowing? Please look at this. Short-term borrowings, 160 million. The note says, look at note number 2. The short-term borrowing consists of overdraft. That means we need to take this. It's part of borrowing now. Plus 160. That means total debt is 260 million. I can now use the second method. Financial gearing is equal to total debt 260 million over equity fund 221 million. Please divide. What is the level of financial gearing? To what extent are this company borrowed money?
117.6.
117.6%. Wow. That means in this PSG business, borrowed money is more than the owner's money. That means in this PSG business, borrowed money is more than the money the owners of the business has provided. This is a clear case of higher financial risk. We can now go to the notes. Look at it now. After we are done with the computation, look at the notes. Which is the evaluation now, critical evaluation and analysis. One positive feedback indicated by this analysis is the growth in revenue, which grew by 23% in 2019 and 21% in 2020. Slightly less positive is the growth in operating profits, which was 16% in 2019 and 13% in 2020. Both years were significantly better in revenue growth and operating profit growth than 2018. If you look at the growth in 2020 and 2019, is better than the growth in 2018. One query here is why growth in operating profit is much lower than the growth in revenue. Better control of operating and other costs might improve operating profit substantially and reduce the financial risk in PSG. The growing financial risk of the company is a clear cause for concern. The interest cover ratio has decreased each year in the period under consideration and has reached a dangerous level in 2020. The increase in operating profits has clearly been less than the increase in financial charge. Look at it. Finance charges is growing at a higher rate, faster than the growth in operating profit. That's a big concern. The increase in operating profit has clearly been less than the increase in finance charges, which has tripled over the period under review. The reason for the large increase in debt is unknown. The company has borrowed more money. Total borrowing is now 260 million. The reason why the company has borrowed more money is unknown to us, but the level of financial risk must be considered in selecting an appropriate source of finance to provide the 200 million in cash needed. We have to consider the level of financial risk. Are we going to borrow more money? Should we borrow more money? Or should we do equity? The company will consider its level of financial risk. We have done all this. That is the calculation of, look at it, gearing. Excluding overdraft. Look at the first one we computed. We have done all this. You can just put your answer here. Look at it, please. I will round up now so that we can go to bed. If you look at this one, this includes overdraft. The first one is exclude overdraft. Look at the first one. This one, we didn't include overdraft here. Percentage 45.2. With overdraft, the gearing ratio is approximately 118%. So we have done that. Look at it. The current financial position of PSG will also be considered by the potential providers of finance in assessing the financial risk of the company. Analysis of the current financial gearing of the company is presented above. The financial gearing based on long-term debt is not particularly high. That is the 45% you have computed. Based on long-term debt. However, the interest cover ratio indicates a high level of financial risk. It is clear from the financial statement position that the short-term borrowing of 160 million are greater than the long-term borrowing. In fact, short-term borrowing accounts for 62% of the debt body. You can compute it. 160 divided by total debt, 260. That will give you the 62% of the company borrowing is short-term borrowing, overdraft. Remember our discussion last week. Overdraft is a risky source of financing because the bank can ask you to repay the overdraft at any time. If we consider short-term borrowing, the financial gain will increase to 118%, which is currently high enough to be a concern for the company. That means with this 200 million, it does not make any sense to borrow money to get it 200 million. You can go on and on. The short-term borrowing is also at an higher interest rate of 8% than the long-term borrowing of 6%. If you go to that additional note number 2, short-term borrowing, the interest payable is 8%. While the long-term borrowing, the interest payable is 6%. Look at the next note. I'll round up now. You can read it. It should be noted that the long-term borrowing are bonds which are redeemable in 2022. That means in 2 years' time, the company must repay the 100 million. PSG therefore need to plan for the redemption and refinancing of the 100 million debt in 2 years' time. A factor that cannot be ignored when selecting a suitable source of finance to provide the 200 million of cash needed. Recommendation of suitable financing option. There are strong indications that it will be unwise for PSG to raise the 200 million of cash required by a means of debt finance. For example, the low interest cover ratio and high level of gearing. That means it is not wise to raise this money using debt finance. If no further debt is raised, the interest cover ratio will improve. If you don't borrow more money, the company's interest cover ratio is likely to improve after the acquisition due to the increase in the level of operating profit. If you go to the note, look at the last note. The last note, by the time we acquire the competitor, we are going to take over the operating profits of the competitor, which is 28.8 million. In as much as we don't borrow more money, our operating profit will increase. Interest payment will remain unchanged. Therefore, your interest cover ratio should improve. Look at the next note here. If convertible bond is used, the increase in financial gearing and decrease in interest cover ratio will continue. Remember convertible debt, debt that can be converted to equity. If we use convertible debt to raise the 200 million, the financial risk will continue to increase. Interest cover ratio will continue to fall. Only until conversion occurs. Assuming the company share price increase sufficiently for conversion to be attractive to the bond holders. Give me like 4 minutes. Once conversion occurs, the debt capacity of the company will improve. Now, once the debt holder converted their debt to equity, the company's debt capacity will improve due to liquidation of the convertible debt and issuing of new shares to the bondholders. In the period until conversion, the financial risk of the company will continue to grow. Next, if PSG were to use equity finance, the interest cover ratio will increase, will improve, because we are not borrowing money again. That means you are going to raise the 200 million via equity finance. That means your financial risk will reduce. But will equity finance succeed? Look at it. Since the company had not paid any dividends in the last 4 years, it is unlikely that the existing shareholders will be receptive to rights issue. If you do rights issue, in the last 4 years, PSG has not paid dividends. You now want to do rights issue, issuing more shares to existing shareholders. Will they buy? They will not be willing to buy. Even if you do public offer. A similar negative view could be expressed by potential new shareholders if PSG were to seek to raise equity finance via placing or public offer. Let me stop here. Look at the conclusion. You can look at sales and lease back of non-current assets. The company can decide to sell some of its non-current assets to realize the 200 million, then lease it back. We call it sales and lease back of non-current assets. Could be considered, although the nature and quality of the non-current asset is unknown. The financial statement position indicates 300 million non-current assets. That means if you sell a non-current asset of 200 million, your asset will reduce. You can now use the money for the new projects, but by selling your assets, that can reduce your earnings capacity. Venture capital can also be considered, but it is unlikely that such finance will be available for acquisition. If you look at this, why the combination of finance could be proposed, the overall impression is that PSG is in a poor financial health, and despite its best efforts, it may not be able to raise the 200 million naira in cash. The record of the company is poor financially. Whether you do equity financing or debt financing or Islamic finance, PAG is unlikely to be able to generate the 200 million. Sorry for taking your time, like 10, 20 minutes. Please, you can go through this, study it, understand this, try to be able to reproduce something like this. Yes, Oluwakemi.
Thank you, sir. Welcome, sir. Please, sir, when evaluating any scenario given to us, are we going to set that calculation? I mean, those ratios.
Are we going to do what?
Are we going to center our calculation, I mean, those ratios that we use to evaluate only on financial ratio and gearing ratio?
Okay. Depending on where the evaluation is taking you. You know that if you are planning to raise money, whether you want to use equity or debt, the provider of funds, we want to know your profitability level. Is that not? They also want to know your risk level. So, in most cases, you are going to look at the profitability level and the risk. There are two things with investments: return and risk. Your return is from your profits. Your risk is your financial risk or your business risk. In this case, we are not talking of business risk because we are trying to source finance. So you are likely to look at both angles. Is that better, please?
Thank you, sir.
We are still going to do more of this because when we get to financial ratio analysis, we are still going to do something like this. All right, let me stop here. We have taken like 15 minutes extra. May God give us a better understanding. Please review this material. I will share immediately after the class. Good night. Let's remain blessed.
Good night, sir.
Good night, sir.